What's up, friends? Welcome back to the Monday video series of the Words of Money podcast. I'm Tess Wicks, your host, and today we're tackling those money goals. So this is episode 46 of #Money Monday, and we're talking about goals and how to achieve those goals using various savings and investment vehicles and strategies. Now, last week we talked about short-term goals and why we use a savings account to save for those goals that are wanting to be achieved within less than a year. But today we're going to be talking about medium-term goals, which is very, very important, and I'm very excited. Primarily because we tend to neglect these goals. We look at those short-term goals like that emergency savings account, and then we jump right into retirement. However, the problem that these short-term savings strategies and really long-term savings strategies have for us is they don't set us up for success when we're trying to figure out what to do about this goal of getting married in a few years or buying a home. First, let me tell you why. With a short-term savings strategy, all you really have is a savings account. And as we know, savings accounts produce about 1% interest if we're lucky, which doesn't help our money make money. It does, however, allow you to pull your money out whenever you need it, which is why we use emergency savings accounts so that if we have an emergency, we can grab that money and other things within the year. But the problem with the savings accounts is very low return. The problem with the long-term strategies, like the retirement accounts, is they're retirement accounts for a reason. You're really not supposed to take that money out for another 40 years or until you turn 65 because the government doesn't want you to. So if you do, you will be penalized. There are some accounts that will allow you to pull out money to buy your first home. They have certain exceptions, but I don't want you to think that that's a viable option because you're saving for your retirement, and if you can start as soon as possible and not dip into it until you retire, you're going to be so much better off. So let's save retirement accounts for retirement, which leads me to the saving strategies for our midterm goals. Now, what are some examples of midterm goals? Let's start with that. And these are goals that are happening after that 1 year mark, but probably before or right around 10 years. Those are midterm goals. So things like marriage, saving up for a wedding. Things like maybe you want to buy a car and you, instead of getting a loan, you'd like to buy that car outright. What a great goal to not have to get a loan and pay off a car loan, but to buy something outright and own it. That's going to take you a couple years to save up for that, but it's a great midterm goal. Another one is to save for a down payment on a home. And there's so many others. Perhaps you're wanting to have children and you want to start saving up because diapers ain't cheap. Or maybe you want to take a trip around the world and it's going to take you a couple years to save up for that because you're going to have to quit your job and then you want to start your own business, and the list goes on and on. But these goals are things that are happening within the next 2 to 10 years. Having a financial strategy for these midterm goals, it's actually probably the more challenging of the three kind of time-framed goals. Short-term goals, you got a savings account. Long-term goals, you can do retirement or other things that we'll talk about next week. But midterm goals, you have to kind of figure out what works best for you. So the first thing I want you to think about is, what kind of investor personality do you have? Are you really afraid of risk? Do you feel like putting your money in the stock market is gonna drive you insane? Or are you more willing to take that risk because high risk, high reward? That's a type of investor personality that you need to discover what's right for you. So first thing is recognize your own investor personality. Second thing is look at your goal. When are you going to need that money for that goal? The other thing is it a hard stop deadline or is there a little bit of flexibility there? And I'll give you an example in a little bit so you can better understand what I mean by that. But first, let's look at those goals that you're going to need this money in 2 years because you want to go to grad school or something, and it's a pretty short length of time. So some options for you there are, you could stick with a savings account. Totally fine, because with these shorter term goals that are still over a year, you're probably going to find that actually the thing that's going to make the biggest impact to get you to that goal is not really the returns you're going to get on the money, but the amount of the contributions that you make and how often you make them. Another option is a CD, or a certificate of deposit. Now what that offers is a little bit higher interest rate than the measly 1% you're getting on a savings account. However, you have to lock your money away for the determined amount of time. So you can find a CD for 6 months up to several years, and that is entirely up to you. So if you have a 2-year goal, you could find a 2-year CD that will give you a little bit higher rate of return, but you put the money in and it has to stay there for 2 years. So savings accounts and CDs, especially if you know you're going to need that money and the expiration date isn't flexible. If you have a little bit more flexibility, but you're still looking at a short-term goal, you could look at investing primarily in bonds, which are a little bit lower risk than investing in stocks. So it's a lower risk, which means you're not going to get as high of return like stocks can offer, but also if you lose money, you're going to lose a lot less than you would in just investing in stocks. That's something that you need a little bit of flexibility on your timeline, just because if you do happen to lose money, you can have some time to make that money back. So we covered that short-term goal with the hard deadline and a little bit of flexible. Now we're gonna get into the longer-term goal. And when I'm saying short-term and longer-term, I'm still working in the range of the medium-term goals, which are the 2 years to 10 years. Now we're gonna look at things that happen, 5 to 7 to 10 years out. Generally speaking, you're probably gonna have a flexible timeline with these goals because they are so far out that you have time to work on investing that money, and then if you lose money, you can gain it back. So with these goals, you could really use just a very balanced investment strategy. And opening up a brokerage account, like I mentioned, or using a robo-advisor is one of the ones that I like to use. Now, I can't tell you what to do. You totally have to figure out what's right for you and what you're most comfortable with, as well as do a little bit of research and make some sound decisions. But this is an example of what I do. Now, I have a goal within 5 to 7 years to put a down payment on an investment property, buying a home basically. And it does have a little bit of flexibility. If I don't have the money I need within 5 years, I have a couple more years. So that allows me to kind of go forward in more of an investment strategy than, say, saving all my money in a savings account, because I don't need the money at a specific period of time. For a balanced portfolio, I love using robo-advisors, because what a robo-advisor does, and we talked about this in episode 30 with Sharice, Conan, and Johnson. I'll leave the link below in the description box so you can check that one out. Robo-advisors allow you to invest in a portfolio of index funds, and they primarily do all the legwork, deciding, how much risk you can take on based on the timeline of your investment. So I'll give you an example. I use a robo-advisor called Betterment. And what I do with Betterment is I put in my information, my age and all of that, and they can set up retirement options for me as well. But for my midterm goal, like my investment property, I say I would like X amount of dollars by 5 years from now. And I do put an end date, which is 5 years, but I know that I have some flexibility when if 5 years comes, I don't have the money, or I don't need the money quite yet. And X amount could be, for me, it's like $30,000. So I need $30,000 in 5 years. What Betterment will do, they'll also make sure they ask me what kind of investor I am. So if I'm moderate, or I'm a risky, or I'm really risk averse, meaning I don't want to put a lot of my money in stocks because I can't stand losing money, they then make the decision on where to put my money. So they look at the timeline, how much time I have until I need that money out. They look at how much money I need, and then they determine how to allocate the funds in stocks versus bonds, because bonds are a little less risky, stocks are a little more, so they kind of determine what that distribution is going to be. They also determine how much I need to be saving on a monthly basis, which really helps me know that if I save, let's say $200 a month, this is just a number I'm pulling out of air because I can't remember what mine is, but if I save $200 a month every single month and they take it and invest it towards my investment property goal, then I know I'm going to get there in 5 years. Of course, it's not guaranteed because it is the stock and bond market, but I have some confidence that it's better than if I just did it completely by myself. And that is why I really love robo-advisors. The other thing is I can set up automatic deposits out of my bank account, which really helps me make it completely passive, meaning I'm hands-off, I can go enjoy myself, and I know that I'm making my way towards my goal every single month. Another great investment platform that I love is Schwab. They have brokerage accounts that you can open up and set up kind of your own portfolio if you wish, as well as Personal Capital is another robo-advisor, but they also have a really unique spin. They have a financial aggregator, so you can see all of your debt, investments, bank accounts, everything in one place, and also see where your money is going as you spend money throughout the month. So Betterment, Personal Capital are great investment options. Personal Capital has that extra thing on top, and then Schwab is another one if you're more in the do-it-yourself phase. Lastly is a little bit more of a balanced portfolio, an even more balanced portfolio if you don't want to put 100% of your money that's going towards this goal into the market. And that is just putting maybe half of your money in a CD or a savings account and the other half in the market. So half of that money could be making money off of the returns, and then the other half is fairly liquid in savings or a CD. So you can access it pretty quickly and know that it's always going to be there. So we covered things from goals that are a little bit on the shorter term end, like over a year to about 3 to 5 years, and what saving strategies or investment strategies you might want to use for those, as well as goals that are on the longer term end of that midterm goal, which is that 5-year mark to 7 to 10 years, and what investment strategies you might want to use for those. Of course, it completely depends on the type of person you are, how much research you're willing to do, or how much you're just willing to give over to someone else to handle for you. And like I said, I can't tell you what to do with your money, but I hope this helps you get a little bit more clear on some of the options that are available for you to start saving for these goals that kind of have flexible deadlines and they're not totally way out there in the future, and you really want to have them. They're important goals to make sure we're saving for on top of that retirement and those short-term goals. Now next week we're going to be touching on those longer-term goals, which are things like not only just retirement, but also sending your kids to college and how you can save for that, as well as other random things you might want to achieve within the next 30 to 50 years. This has been episode 46 of the Words of Money podcast. Make sure you watch it on YouTube, listen to it on iTunes or Stitcher, and I'll give you an option to subscribe to the podcast. Please do that. It really helps the show get noticed by more and more people if you subscribe and you leave a review on iTunes or Stitcher, and sign up for the email list. All these links will be on the card at the end, and you can make sure you get all of that, and check out the show notes at tesswicks.com. Thanks so much for hanging out with me. Until next week, I'll see you later.